For our market moves segment today, I'm joined by Jeff Cohn, our Chief Investment Officer and CFA charter holder here at Benedetti Gooster and Associates and Beam Wealth Advisors. We had an episode earlier this summer about the first half of 2023, so I feel like it's only right to review the rest of the year now that we're here in December. But like always, we like to start with an icebreaker. I think for the first half of 2023 episode, I asked you a recommendation for a show or movie. Now that we're in December, it's Christmas season. Do you have a favorite Christmas movie, Jeff?
Oh, yeah, easy. So I'm a huge Jim Carrey fan. And so The Grinch That Stole Christmas by Dr. Seuss with Jim Carrey in it is definitely one of my favorite iterations of The Grinch in general, but also a great Christmas movie. And then also the little girl that plays Cindy Lou, Taylor Momsen, is actually the lead singer of a metal band now. So that's a little
Interesting. That is quite the transition there. But that sounds great. It's a great movie. I'm more of a Home Alone fan myself. But let's get into it. Let's talk about the year.
Let's go.
Hello and welcome to the Map Your Money podcast, a production of BGA Teams. We exist to simplify the lives of our clients and listeners and help you lay the course to meet your financial goals. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the show was pre-recorded earlier this week.
All right. So we want to mainly focus on the year in 2023, reviewing the year. I think we'll probably do another episode at the beginning of the year talking about what we're expecting in 2024. I guess it's only natural we might talk about that a little bit, but mainly trying to review 2023, everything we saw this year, what we saw coming into this year, and kind of how we met those expectations. And so I think it's only right to start with inflation coming into the year. That was by far the biggest story we had in terms of the economy, the markets, where we were as a country. And so I guess, Jeff, can you touch on kind of how we've seen this moderation in inflation throughout the year?
Yeah, so inflation actually has come down. It's trended lower since basically the midpoint of 2022. It peaked in June of 2022 at around 9%. If you look at the headline CPI, some of the core measures peaked out at around 6 or 7. But overall, all of these measures, and we measure inflation in a lot of different ways, all of these measures have trended lower to a level that's unfortunately right above the Fed's target of 2%. Around the summer of this year, there was some talk that, hey, maybe inflation's settling in at this 3.5% range. We saw it go sideways. But then really these last couple of reports, we've seen a lot more progress. We've seen inflation continue to come down. Some of the core measures are now at 4 and 3%, which is very important. And then, we actually have reason to believe that inflation is going to continue to come down and that there's actually some disinflation in the pipeline, so to speak.
Yeah, no, it's definitely something that's really important and been a driving factor in terms of the health of the economy and the markets. I know, like you mentioned, June 2022, we peaked around that 9%. Coming into the year, we were still at 6.3%. So to be around 3%, I think that is very healthy for the economy right now, and hopefully we continue to trend in that direction. I know CPI, that Consumer Price Index, one of the big factors within that is housing, and I know you have some commentary there on kind of how that's impacted that inflation number, if you want to touch on that as well.
Yeah, so housing, the shelter component, it's about a third of these price indices. So if you see a pretty big jump in housing, that's, it's given a third of the weight, so it's going to impact the total number quite a bit. And interestingly enough, the way they measure this housing component, or the biggest part of it, is something called owner's equivalent rent. And it's basically saying that somebody that owns their house is able, if they want to rent out the house and receive rental income on that property. And by not doing that, by living in the house instead, they're, giving up that income. And so that is, the way economists would look at that is a cost associated with owning a house. It's income that you're giving up in order to use it for your own purposes. And this measure can actually be pretty volatile based on, housing prices, based on new rent prices, new lease rates, et cetera, et cetera. So they actually built in a bit of a lag and a bit of a smoothing mechanism to make sure that it doesn't make inflation jump around a lot like we see sometimes with oil and gas prices. Unfortunately, what this means is that in 2020 and 2021, when housing prices were skyrocketing, we were understating inflation because owner's equivalent rent was not showing the 15-20% jump in housing prices that we observed. It was closer to, you know, 5 or 6% range. Well, now that we've seen lease rates come down, or at least the growth in lease rates come down, we've seen housing prices peak out, and they've actually trended lower or sideways since then. This owner's equivalent rent metric hasn't come down. It's actually been around 7-8% for most of 2023, and only recently has started to come down to show year-over-year increases of, you know, right now at 6.8%. And if we look at other measures that are more closely following what's happening on the ground, such as the Zillow Rent Index, the year-over-year increase for that right now is 3.2%. And this is something that owner's equivalent rent tends to follow over time. And so we actually think, hey, if you actually substitute 3.2% or 2% or even 0% into this shelter component based on, you know, housing prices going nowhere, then we're actually at an inflation rate of 2%. And that's really important because it's not really a matter of if that comes down the pipe and shows up in inflation numbers. It's a matter of when. And this is something that we've been talking about all year. It's a reason that we've been very convicted that inflation is going to come down, and we're just now starting to see that play out, and I expect it to continue.
Yeah, no, that is really interesting in terms of the owner's equivalent rent basically keeping inflation, I don't want to say artificially high, but higher than we expect it to be going forward, because we'll see this moderate over time since it's more of a lagging indicator there. So that'll be interesting to see, and hopefully we can see that inflation continue to moderate closer to that Fed's target, as you mentioned, right around 2%. But Jeff, I know we touched on this in that first half of 2023 episode. It was a major story at that time, and it's continued to be a major story for all of 2023. And that's how top heavy that this market has been in this year. And so do you want to quickly touch on how these top stocks have driven the majority of the return in this year, and it's now led to what we call a valuation discrepancy?
Yeah, so, you know, we've talked about some of the statistics, how NVIDIA, you know, the top performer this year. Meta is also in there as one of the top performer. I think Tesla's up 80-90%, Microsoft and Apple up close to 50%, right? And these stocks have had really good years. They're all the biggest components of the underlying index, such as the S&P and also the NASDAQ, which are two closely watched stock indices. Well, throughout the year, basically none of the other stocks were really joining the rally. If you look at, you know, say the Russell 2000 year to date, it's only up 6.9% versus the S&P and the NASDAQ up 21 and 37%. So a pretty big discrepancy there. I'm not really sure what the updated number is for how much of the return is from the Mag 7, but something I think is interesting is that the top 10 constituents of the S&P now make up almost a third of the entire index. And, you know, that's pretty substantial, and that's gone up quite a bit from, say, you know, 16-17% just 10 years ago. And a lot of that's because of the growth in some of these mega cap names. And what's happened is the valuation of those top 10 stocks is now 140% of the average. So 40% higher than the average valuation of the top 10 stocks over the last, call it 20 years, 20, 30 years. And the remaining stocks are trading basically in line with the historical average. So it's one of those things where you have one group of stocks that's doing really well, outpacing the rest of them, and have gotten really, really expensive, while some of the other stocks in the market really have gotten left behind and are trading at discounts. You know, one other thing I note there is, you know, we look at large cap stocks, we look at mid cap stocks, small cap stocks. Mid cap and small cap stocks typically trade at a premium to large cap stocks because they're smaller. There's expectations that their earnings will grow faster. Maybe they're small or mid cap companies because they're in a new industry or new technology driving adoption of a new product, and they need some time for that to come to fruition. Those usually trade at a premium to large caps, but right now that's actually not the case. Right now they're actually trading at a discount to large caps, and of course these are all companies that really have been left behind. And, you know, I have to say that large cap stocks, Microsoft and Apple, they may have monopolies in their own markets, but they don't have monopolies on good, competitive, high quality companies.
Yeah, definitely. I think that was interesting what you mentioned about those top 10 holdings having almost a third of the S&P 500 index right now. I think it's 32.7. And on this graph that I'm looking at right now, it looks like it's the highest it's ever been dating back to 1996. I'm curious to know what the overall, if it's ever been higher than that. But that those top 10 holdings, although they make up 33% of the index, almost 33% of the index, only contributing about 21% of the earnings of the S&P 500, shows that big valuation discrepancy that there is a lot of opportunity in these smaller stocks. You mentioned how the S&P 500 is up about 20%. The average stock in the S&P 500, however, is only up about 6%. And so that kind of shows that as well. And then also wanted to clarify, you mentioned Mag 7. That's the Magnificent 7, which is now the new name. I knew they had the Fang M and all these different variations of it, and it's now the Magnificent 7 to recognize those top 7 biggest companies in the S&P 500 right now.
Yeah, there's been a lot of catchy phrases in the market recently. Right?
Yeah.
We had Fang, now we have Mag 7. I don't know what it's going to be next year. Another one this year that we heard a lot was T-bill and chill, because a lot of people were a little scared to put money in markets, right? Yeah, and like cash was getting you 5%, the highest part of the yield curve, and people were saying, hey, just stick it in cash or T-bills and chill.
Well, with that T-bill and chill, it's a great transition into the next point I wanted to mention. With kind of moderating inflation, the Federal Reserve had to increase interest rates, which led to these awesome opportunities in the bond market and in fixed income, something that we haven't really seen in the last 2 decades. And so, Jeff, did you want to kind of touch on now the greater role of fixed income as a whole in portfolios?
Yeah. So think about it this way. The investment universe is comprised of essentially 2 types of assets: risk-free assets and risky assets. The risk-free asset is going to pay you some rate. Usually it's cash or a T-bill or something like that, and it's going to pay you a rate. A couple of years ago, that rate was, say, 1% or even lower than 1%. And so if you wanted a return higher than that, then you had to turn to that other category of assets, which are risk assets. Now, these could be corporate bonds, they could be longer-term treasuries, or they could be stocks, private equity. But the higher and higher return that you needed, the further and further out on that risk curve that you had to go. Well, now that T-bills, the T-bill and chill strategy is going to annualize you around 5% if interest rates stay where they are, then that means that a lot of people that were recently forced out into long duration treasuries, which weren't even yielding 5%, or even corporate bonds, which some of them weren't yielding 5%, they can actually employ a very safe strategy and earn those higher returns. And I think what's interesting about bonds that is maybe missed on a lot of people is that, unlike stocks, you don't need the price of a bond to go up to make money. This is really, you're really just getting paid to sit there and hold an asset that is paying you interest. And unlike stocks, bonds basically have no upside if you buy them at par, right? You loan somebody money at par, let's say $1,000, they're going to pay you 5%. That's $50 a month. And then at the end of bond's maturity, they give you back that $1,000, right? And so most of your return on the bond is really about that yield. It's really about that coupon that you're getting in the meantime. And now interest rates can fluctuate, and that's going to impact the price. But overall, it's about that yield. And what we've seen is that over the last several decades, 87% of a bond's return is based on its starting yield. And so right now we have starting yields that are some of the cheapest that we've seen since before the great financial crisis. And this is true not just in risk-free assets like T-bills, but also true in corporate bonds, private credit, and a lot of other income-producing securities, municipal bonds for some of our clients that prefer tax-exempt interest. So we think that this is a big opportunity for a lot of clients that were forced out on that risk curve to take a step back, reduce risk, and still earn higher rates of return.
Yeah, and one thing I always like to do with clients in general is look at where they are in terms of their financial plan and say, okay, what are we assuming in your financial plan to meet your goals? So let's say for a client, we're assuming a 6% rate of interest each year. Now, to achieve that 6% that we need for them to achieve their goals in retirement, we may not need to take as much risk on the stock side because we're able to get such favorable yields on the bond side. And so that now is going to be a much bigger part of clients' portfolios, and it's a switch that we've made over this year. And definitely a big story from 2023. And this is, I guess, kind of going to be more of the conversation we have come beginning of the year when we're talking about 2024. But we don't necessarily expect yields to immediately come back down to where they were pre-pandemic level. I think that level was kind of unprecedented and might not be something we see for a while, even if we do see some rate cuts towards the end of 2024.
Yeah, I mean, something that I would encourage our listeners to think about it in this way, right? Markets, they do this thing called reversion to the mean. And the mean, meaning average, it can be anything. It could be a long-term average. It can be some theoretical level that the economy can sustain for a certain period of time. That's typically how we think of GDP growth. But for interest rates, that neutral level or that average level is supposed to be the level in which interest rates are not so low that they're stimulating the economy, but also not so high that they're restricting the growth of the economy. And what's interesting about the pre-pandemic level is, pre-pandemic and going into the pandemic, is that interest rates were very, very artificially low, well below their average level. And so right now they're well above their average level, right? And eventually this is going to settle out into some kind of quote unquote average. And so, yeah, we have conviction that rates are going to come down because they have to, by nature, they have to, by just the law of averages. We've been at restrictive level for so long that eventually it's going to have to go back down to that average. And if you think about what that potential level is, well, guess what? The Fed tells you what they think it is. They think it's 2.5%. That's their long-term projection for the Fed funds rate. And right now we're at 5.25%. And so if you think about, nearly 300 basis points of cuts, that has to happen just for the Fed to get to neutral, just for them to remove the restrictive policy that they've put on in place. And think about it, what were they trying to kill with this restrictive policy? Inflation. And we think inflation is going to continue coming down. So yeah, we think actually the path for interest rates is lower from here. And if you're clipping a 5% coupon every year waiting for that to happen, we think that's a decent trade for an asset class that has a third of the volatility of stocks.
Yeah, definitely. And I think that's another opportunity in bonds as well, as we're at this very high water mark with bond yields. If it comes to the point where, and like you mentioned, the Federal Reserve has this target for interest rates at that, what'd you say was that 2.5%?
Yeah, 2.5% level. And that's assuming that, an inflation rate of 2%. So the real Fed funds rate is 0.5%.
It's 0.5%, yeah. And so with that rate cut, I know in the past we've talked about that, the relationship, that inverse relationship between price and the yield. And so if yields come down, if there's rate cuts, then that's only going to increase the price of bonds that you hold now. And so kind of getting that coupon and that price appreciation as well, which makes it even more of a compelling opportunity there on the bond side.
I think a good way to visualize that is the coupons, the interest that these bonds are paying. It's not like your savings account that's going to change that rate all the time. That interest on that bond is locked in. And so when market interest rates change, you're still receiving that higher coupon. So if interest rates go down since the time you've purchased a bond, think about it as other bond investors are willing to pay a higher price for that bond because it's kicking off more yield. And basically what that price adjustment is to equate it to whatever the prevailing market rate is.
Definitely. And so I guess the last topic that I wanted to discuss was more so just the economy as a whole. I think it was pretty common sentiment across economists and just people in the industry that we were going to be coming into a recession at some point in 2023. And so, Jeff, I wanted to get an update from you where we are economy-wise now. What areas of the economy might still be holding up well, and what areas might be showing a little bit more of that weakness?
Is this a gotcha? Are you calling me out for being wrong about a recession call here?
No, it's a good gotcha. We're happy we're not in a recession.
Yeah, it's a good problem to have when you're wrong about a recession happening. So something that I'll say about economic numbers right now. It's clear that we're not in a recession. There's a lot of talk about whether we're going there or how long that's going to take. But if you look at the indicators right now, we're clearly not in recession. Real production is up. Real spending is up. If you look at the components of real GDP growth, so this is adjusted for inflation, before the pandemic, the pre-pandemic trend for consumer spending was growth of around 2% a year. People bought 2% more stuff a year. And if stuff cost 2% higher, then they spent 4% more a year. So that's the difference between nominal GDP and real GDP. Well, right now, consumers, that spiked during the pandemic to around 15% on an annualized basis. Now it's back down to that 2.5%. And I think what's interesting is it's not like it went from 15% to 0 to -2 back to 2. Mm-hmm. It went from a well above average level right back to the mean. Usually things cut below the mean and then kind of reverse back up, but that's really not what we've seen with consumer spending. Business investment has definitely been a little weaker than we would expect, and this is a pretty volatile category. Obviously, interest rates are going to affect how many businesses want to borrow money and invest that into the economy, but even still, that has rebounded recently. And then, of course, government spending, which a lot of people are going to be surprised, was at negative for a portion of COVID on a year-over-year basis. No worries to those people. The government has started resuming their spending ways, and so now that's also contributing to GDP growth. So, overall, real GDP growth remains healthy. And you talked about why that is. What's the strength that we're seeing in the economy? It's pretty simple. employment remains really strong. People are still able to find their jobs, to hold on to their jobs. And when people have jobs, they have income. And when people have income, they spend it. And, that's pretty healthy for an economy where 70% of it is consumer spending.
Yeah, definitely. And I think that's the biggest takeaway in terms of the health of the economy and GDP in general is, are the individuals in the economy still spending? We've had this really high inflation. We can get much higher yields in a savings account, both of which are typical reasons that would lead to less spending in the economy. And we haven't really seen that. And that's kept the economy healthy. And you mentioned unemployment staying strong. And I know it has been strong, but we have seen a little bit of cooling there, right, Jeff?
Yeah, so we've seen a little bit of cooling. The unemployment rate was around 3.4% earlier this year in the summer, I think. And recently it increased to 3.9, and we actually got the new report this morning. This is Friday, December 8th, and it looks like the unemployment rate dropped to 3.7. Now, in my opinion, it looks like there was some people returning to work after labor unions received their deals and signed their deals, and all those workers returned. Because in the household survey, it showed an increase of like 700,000 people that got jobs, right? So really, that's just the people that got laid off because of the strikes, and then they came back, and that creates a little bit of noise. But overall, what we've seen is the number of the amount of people getting hired per month has definitely trended lower. But again, kind of like GDP, it's kind of trended back to its pre-pandemic level of around 150,000 to 200,000 jobs a month. Today's report was 199,000, for last month. And again, if you look at other kind of metrics that are going to gauge the demand for workers or how companies want to hire workers, so look at job openings and look at average hourly earnings. They're both trending down, but they're still at pretty healthy levels. So if you look at average hourly earnings, you're talking about consumers and spending despite inflation. They're at 4.1%. Well, we just said that core inflation is at 3%, which means, hey, I might get dragged for this, but real incomes and real wages for consumers have been rising over the last few months because wage growth has not come down as quickly as inflation, which means that consumers actually have more money. So still some signs there that overall things are holding up. The one caveat, and I hate to do this to you, the one caveat is that the unemployment rate typically rises just a little bit right before that recession. And there's been this historical pattern of if the unemployment rate rises by 0.5% or say from 3.4 to 3.9 like it did here, we always have a recession. And that's something that worries me. That's something that I think should give investors some caution. But again, this is not black and white, right? The economy is very complex. There's a lot of things that can happen that can derail any kind of estimate or forecast. But right now, based on what we see, things are weakening. I think the question is, do things weaken and then kind of hold steady at the average, or do they fall through that average and we go to recession? Still yet to be determined.
Yeah, and I think that is a good transition into, I guess we can go into this more in sort of our next episode and talk about, are we expecting that recession in 2024 and what that looks like? But are there any other leading indicators that are showing positive or negative signs going forward with where we're at right now?
So most leading indicators are forecasting a recession. And they've been forecasting a recession for quite a while, which is why a lot of practitioners like me have been wrong about it for so long. Some of these reliable indicators, such as a yield curve inversion, for instance, where short-term bonds are actually yielding more than long-term bonds. Well, why would that happen? Well, it's because people expect interest rates to fall because they expect we're going to go into recession. Typically, when that inversion happens, we have about 18 to 24 months before a recession happens. So we're kind of still within that target range from when the curve inverted for us. But I think even more interesting is that inversion gets wider and wider, and then all of a sudden starts to narrow. And that narrowing typically happens like right before the recession, like right as we're going into it. And that's what we saw during the summer. And so again, like we have some other leading indicators that are showing, hey, maybe reasons to be cautious. And then, really to sum it all up, there's an index of leading indicators of 10 different indicators that the conference board put together. They weight them in various ways to have the most explanatory impact on whether or not we have a recession. If that indicator goes down 7 months in a row, we've always had a recession. Wow. It's in month like 16 or something. Like it's showing that we're going to have a recession. A recession's going to happen, pretty soon. And the caveat being is that it's shown that for a while.
Exactly. And as I mentioned, that was very common sentiment coming into the year because of all of these leading indicators that we're predicting us having that recession. I feel like it's just kind of moved down the line. So it'll be interesting to continue to watch and see the health of the economy and how the markets react to that. And of course, we'll be here in 2024 covering that. And but as always, thanks for joining the podcast, Jeff. It's always great to zoom out and get your perspective. But would you have one other thing you wanted to mention there?
I got one other thing. We didn't talk about market
Let's
returns.
do it.
So something that I think is very
Can't
interesting
miss that.
that we need to remember, take a step back, is that despite what we expected for the economy, despite what we expected for inflation, all that, we remained invested in markets. And markets, through all the talk about a recession and through all the indicators that we've gotten that show weakness, are still having a great year. Even though the average stock is only up 6%, the Russell 2000 is only up 7%, S&P up 20%, that's going to get it done, because even though not all of our equity allocations in the S&P, that's still a really strong return. And something else is that, hey, sometimes the pattern of this data doesn't exactly follow as closely as you expect. And so since October 27th, that's really when the market started to embrace this. Inflation's lower. We're going to have a soft landing, and so the Fed can back off. Since then, a lot of factors that we watch, large cap value, small cap value, et cetera, are all up double digits, with small and mid cap stocks outperforming. So I think it's one thing, we pay attention to the macro factors, we pay attention to the risks and opportunities, but we also stay invested, and we're always looking for opportunities to find that good return. And I think it's really important to not try to time that market so quickly, because in a matter of weeks, we doubled the return on the S&P from the lows back in October 27th. So something important to point out.
Yeah, no, I'm really glad you added that point. I think that's a great point to make in terms of never wanting to time the market. If you're always following the news or macroeconomic events, it's very easy to say, okay, I'm going to sell my stocks now or get out of my portfolio, move to cash now, and then once we see a rebound, I'll join back on that. And there's a ton of statistics on why that doesn't work. The just missing a few days out of the in a year really is a massive detriment in terms of your overall return. And if you did that coming into this year, all that recession talk, you would have missed out on what turned out to be a really good year in the market. And so just because we see those leading indicators may suggest a recession here in 2024 doesn't necessarily mean that we're going to have a bad year in the market. And so I'm glad you added that point, and I think that's really important for the investor and our listener to understand. But kind of going back to that concluding piece, appreciate you joining as always, Jeff, and really giving us more perspective on the market and economy as a whole.
Yeah, thanks for having me. Go look up Taylor Momsen, The Pretty Reckless. Okay, Cindy Lou Who, she kills it.
There you go.
All information provided through this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside Benedetti, Gooser & Associates and Beam Wealth Advisors. All examples are hypothetical and for illustrative purposes only. Benedetti, Gooser & Associates and Beam Wealth Advisors do not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.